So let's go on with the magic of moving averages. Now, a lot of people, and I've been teaching for a very long time, and a lot of people come to my classes and say, aren't moving averages too simplistic? I don't use moving averages, they're just too easy. They don't tell you anything. But the fact is, moving averages are an incredibly great tool, and they can be used many different ways. Moving averages help Forex traders make effective transactions by aiding them in evaluating the price history of a currency pair or a related investment. More specifically, these averages make it easier for investors to interpret the price fluctuations of an asset by smoothing out their random movements. Now, a bare basic moving average, which we can call a simple moving average, and if we were using a 10 period simple moving average, what we would do, we would take the 10 closes, add them together, and divide it by 10. That's pretty easy. And yeah, that's very simplistic. Now, let me pop up a live chart. Give me a second. I'll get a live chart in front of us here. Okay. When I talk about moving averages and I talk about periods of movement, a moving average is the calculations of the last 10 periods. So if you're using a 30-minute chart, it's the close of the last 30 minutes. So that moving average would be covering what? The last 300 minutes of your trading. If it's a 1-hour chart, it would be the close of the last, if we're using a 10 period moving average, would be the close of the last 10 hours. And the last 10 hours would be the 10 hours of trading. Okay, a moving average automatically adjusts to the chart. A moving average is also based on the close. Now, I'm saying that because that was the standard rule of thumb when I started trading many years ago. But today, we get too many choices. Okay. These new HTML charts and these well-advanced technical developers who do all the development on these new HTML charts, they're not traders. And they think about choices and calculations, and they don't think, well, is this important, or how does this affect the calculation? And then all of these odd and end gurus out there trying to come up with a system to break the market or tell you how wonderful it is. The more choices you give them, the more absurd or the more out and left field choices they give you. So today, you have things like a moving average. You can set it to automatically adjust to the chart time frame, or you can say it always, no matter what chart frame use it on every 30 minutes. Okay. Maybe somewhere out there somebody's figured out a way to do that. Also, when I say the moving average is based on the close, now for 25 of my trading years, all we have was the open, the high, the low, and the close. Today, we can set our moving average based on the open, the high, the low, the close. The high and the low divided by 2, the high, the low, and the close divided by 3. We can use it on EMAs. We can use it. The choices go on endlessly. But the rule of thumb, it adjusts to the chart and is based on the close. Okay. I just wanted to get that past you, because what eventually happens, I get all these emails saying, you said this or you said that, and that's not the case, or you don't know what you're doing. Okay. I can only give you the basic rule of thumb that we followed for years. We have lots of choices out there. In fact, today I'm going to show you one of the newest moving averages actually that I've started incorporating in my trading, and it's very helpful. Now, on our chart, let me just put a simple moving average on here and get rid of. Okay, so we're going to put on here a 30 period moving average. And let's make it easy for you guys to see. We're going to make it in, let's do purple. And we'll make it a very broad line for right now. And let's turn off this other mess I have on my calendar, on my charts here. Okay. So this purple line going across the, actually, let's change this to a bar chart. It's just easier to see. That's the only reason I'm changing. Okay. So this is a basic, simple moving average. It's a very simple tool. The only thing that a moving average like this, a basic moving average like this does for us, is it helps us take the noise and the randomness out of markets, because price jumps all over the place all the time. And it will help you, number one, stay on the right side of the trend. And it will alert you when the trend is bouncing back and forth. There is a basic rule of thumb or a trading system that says, it's called red light, green light, and says you would only consider a buy. Now, this is not part of your strategy. It's not telling you to do anything. But no matter what your strategy said, you would only consider buying when the moving average is above, when the price is above the moving average line. You would only consider selling when price is below the moving average line. But like I said, that's a real simplistic red light, green light piece of information. Now, a moving average is also the backbone of a lot of indicators and oscillators that we use every day. Like down below, we see MACD. Now, MACD uses a 12 and a 26 period moving average. Like I just dropped on the chart above, the red line, the blue line, and the gold line, and calculates the difference between these moving averages to make what we call the MACD line, or the basics of this calculation down below. So we use moving averages more than we think about. We also use moving averages in other indicators such as Bollinger Bands. Bollinger Bands is based on two standard deviations above and below a center line. That center line is a moving average line. It's a 20 period moving average, and the upper and the lower bands are based on deviations from that line. So moving averages are used a lot in a lot of different ways in our everyday trading. And there's also many strategies that incorporate moving averages. We have moving averages that we use to verify other trading systems. Like here, I've got a very simplistic support and resistance trading strategy, but we use our moving average line to verify that buy or that sell, because we only want to enter those buys and sells based on that red light, green light system. So no matter what our trading strategy is, we want that confirmation tool. Then we have multiple moving averages. We have moving average crossover strategies, moving average fan strategies. Okay. So all of these can be incorporated into your trading system. Now, when we're using two moving averages, we call that a moving average crossover system. Now, keep in mind that if we're using a moving average crossover, it's using two different time periods. And we'll talk about how to figure out these time periods you should be using. But when we incorporate it to a third time period, like here, my examples are 30, 60, and 90 period, we get a very interesting picture, because let's start. The shortest period moving average is called the fast moving average. Why? The shorter the period that you're using, if you were taking a 30 period moving average, you would take the close of the last 30 periods, added together and divided by 30. If you were comparing that with a 60 period moving average, you would do the same thing over 60 periods. Well, which one's going to react faster to time differences, to price shifts in the most recent time? The shorter moving average. So it's referred to as the faster. But when you think about this, that a 30 period moving average, or that's actually for our type of trading, let's use a 10, 20, 30. Okay. Okay, now we're using a 10, 20, 30 right here, which fits our type of trading a lot better. When we do this, we see some differences in how the moving averages separate and how they cross over. They together give us some very interesting trading pieces of information and give us very unusual buy and sell points that are fairly reliable. So today, because charts are so well, we can actually apply this using what's called a moving average crossover strategy. And all we do is set the periods we want, and look at that. Automatically in our charts, it tells us each crossover, and it's telling us exactly what to do and how it's worked here by simply setting it all up in our settings. And what it's doing, it's not only giving us the signal label, it's giving us a quality and a quantity of that signals, how good it was, how reliable it is. Okay. But these are all different ways we can incorporate this into our trading strategy by combining this with a MACD histogram and RSI. We've actually built ourselves a very good trading system. So let's go back to my PowerPoint. Let's talk about the different types of moving averages and how we would add them into our trading. Now, we've been talking predominantly about what's called a simple moving average. Now, moving averages, no matter how you look at them, fall into what we call lagging moving averages or lagging indicators. Why? Well, first, what's a lagging indicator? It's not like your kids in school and the teacher called you and tell you he's lagging behind the class. Lagging indicators are not bad or good things. Okay. The kid's lagging behind his class, that's a bad thing. A lagging indicator is based on the fact that it needs to use past price movements to calculate its next step. In other words, your moving average for this period is the calculation of the last 10 price closes divided by 10 and then put on your chart. So that price had to already have closed for the system to do the calculation and drop it on the chart. So it's a lagging indicator, and most indicators are lagging. What lagging indicators do is they confirm a price movement as opposed to predicting the future. Okay. Now, for us as traders, this is a worrisome point because we're trading in fast trading markets, and finding out where something is and predicting the future are important. we always want to be able to know what's happening in front of us. So in order to make this less of a lagging indicator is the not the gurus, not the developers, but the market has developed what's called, or statisticians, that's a better word, have developed what they call an exponential moving average. And the criteria for an exponential moving average is gives more importance to the most current price level rather than just the closing prices of the previous periods. Because follow me, if gold was trading at 1450 10 periods ago, 1450 9 periods ago, then went to 1425 on the 8th period, back to 1450, back to 1475, back to 1450 and stayed at 1450. But in the last session, it jumped to 1500. What's more important to you? That it went to 1425 8 sessions ago, then went back to 1450 and stayed at 14? Or is it more important to you that it went to 1500 in the last session? So an EMA gives more weight to the most current prices. Still goes back 10 periods, but it gives an edge to the most current period. Now, to calculate an EMA, now you'll never have to do these calculations. Okay, computers do them for us, they're dropped on our indicators. But a lot of times, like if you're building yourself a moving average strategy or putting the moving averages on your charts or whatever you want to do, try to think about using the EMA instead of the MA, or the simple moving average. Okay. So to calculate these, like I said, you'll never have to do, but the moving average starts out by just doing the same thing for the 10 periods, but we know we're using 10 periods, and we get what's called a multiplier. This multiplier is derived from the length of the period that you're looking at. So in other words, the multiplier would be 2 divided by the number of time periods plus 1. So we stick with my 10-day or 10 period ratio. We would take 2 divided by 10 plus 1, and that gives us a 0.18. So that's the multiplier we apply at the end to give more weight to the most current level, the most current prices. It's not a big difference, but it gives some weight. So once the multiplier has been acquired, we use the following calculation. Use the multiplier times the closing price minus the previous EMAs plus the previous. In other words, we're using 9 periods plus the current period times the multiplier. So let's go back to the chart and I'll show you an MA. It's not a big difference, but it's enough to help us be a little bit better in our trading. Okay, so the purple line is a 30 period simple moving average. And now the gold line is the same period, and it's a 30 period EMA, an exponential moving average. So as you can see, it's got slight variances and differences to it, but it helps us in our calculations. So keep in mind that when you're using an EMA, you have moved that indicator a little bit farther from lagging and a little bit farther over to helping predict what's happening in the future. Now, there's also things like, and I don't even know how it's calculated. I'm not going to, because it's a very difficult calculation. But then we have what we call volume weighted moving averages. Okay. The fact is, in our type of trading on a CFD platform, and outside really, unless you're trading some commodities or you're trading stocks, the actual volume is only the volume through the liquidity provider and not through the global exchange. If you're trading, if you're really trading, buying Facebook shares or looking at the volume on the New York Stock Exchange, that's the full volume for Facebook everywhere. When you're looking at, we're only talking volume, not pricing. When you're looking at the volume on a broker's platform, that's the volume being placed through the liquidity provider for that year. Now it relates directly back to the total volume, but so keep in mind, we don't want to use volume weighted moving averages. And now we come to the newest, and this is thanks to the technical developers and the HTML charts of moving averages. And like I said, I've incorporated this into my trading strategy, and all of my trading, actually, into my all of my decision making, my strategies, and it is called a DMA. This is called a displaced moving average. It is the same exact calculation as a simple moving average. So if we're using a 10-period simple moving average, we're going back 10 periods, adding the 10 closed together, dividing by 10, right? We know that. Okay. But what does the DMA do? Well, it helps us cheat. It helps us flip a moving average from a lagging indicator to a predicting indicator. And how does that do that? With no mathematical calculations. Now, because this is relatively new, I'm sure there's some gurus out there trying to teach you all kinds of, trading methods or trading get rich quick schemes about using this. Okay. And like I said, it's not a calculation. Let's turn off this EMA for a minute. Okay. We're looking at this, the euro US dollar, and we're looking at let's change this to a 10-period moving average, only because these are just easier for me to show you, isn't it? Now this is a 10-period simple moving average based on the close. I'm going to add another moving average, another simple moving average directly under our charts, which if you notice, you can't see because it's exactly the same as this one. Well, we'll be in a second. We're going to leave this at a 10. Okay. What a DMA does, it uses what we call an offset. Okay. Means got nothing to do with the calculations. What it has to do with where it's putting the dot on your chart. Now, for me, I use a 3-period offset. Okay. Again, it doesn't change our calculations one drop. It only changes where the computer puts the dot on the chart. So the blue or the aqua color is the DMA with the 3-period offset. So in other words, this most recent calculation is actually put the dot here. When you do that, we start to see that we get a more accurate understanding of what the market movements are doing. And this is helping us predict what's happening. Okay. Now, you can combine it with a regular moving average. I just use it because what it does, and I'm finding it extremely reliable for my trading because it's only part of a small system. But by looking at the correlation between the SMA and the DMA, I start to get more understanding of where the market's going, because I can, as you know, we can only trade here, and we can only trade what's going to happen there. Okay. Since nothing has happened there yet, okay, all of a sudden now I have actually something that's telling me what's happening, what should happen there. So it's helping to give me an evaluation of the markets. So it's the newest of many different types of moving averages. But like I said, there's no difference in the calculation. It's simply where the dot is put on the chart. Now, as I said, I use a 3-period offset. There's all types. You can use a 5-period. You can use a 10-period. So it's up to you because you have to test it in your strategy to understand what it's doing and interpret it. But every time we can find something newer and more advanced that's reliable, we have a chance of improving or better defining our trading strategies. Now, the results of a DMA are very, very fascinating. It gives us because remember, a moving average also gives us support and resistance levels. Remember, we were talking about the green and red, buy or sell above and below. It's also one step in front of the market now as opposed. So it's just these small influences that will help us improve our outcome. Okay. I'm not telling you it's going to change your trading. I'm not going to tell you it's going to give you great buy and sells. What I'm telling you, it's a new tool that you can incorporate into your trading strategy. Now, once a trader has calculated one or more moving averages, he can then use a wide range of purposes. Many investors utilize these indicators to determine what trend a security is following. For example, a currency pair could follow an uptrend for a period of rising values during a time frame. Most investors seek to identify these trends and then try to profit from them. So the moving average will help you see where the market is going and whether that it is in an uptrend or a downtrend. Now, time periods become critically important here. Okay. Now, I know some of you've written in about time periods and time frames. Okay. There is no magic number. But the fact is, you coming up and saying, I'm going to beat the markets because I'm going to use a 43.5 period SMA. Not going to make a difference. It's not going to outsmart the market. It's not, because a moving average is just a calculation of the last closes divided by whatever. So if I take 42 and you take 43.5, it's not going to make enough of a difference. Now, there are standard ranges that we would use. Like for short-term trading, really going beyond a 20 window is going way too far. So the standard is 9, 10, 9 or 10. Okay. And then we can use combinations of 10, 20, 30. We could use a 30, 60, 90. You could use a 12, 18, and 24. Okay. But it's really, now there's certain indicators like MACD and Bollinger Bands that already their whole formula is based on specific moving averages. MACD is 12 and 26 and a 9. A Bollinger Band is based on a 20. What do I use for my trading? Depends on what I'm looking at, what market class, what asset class, okay, and what type of market and what I'm trying to sell. Am I looking at environmental information to give me an understanding of whether this asset is just trending up or down and where it should be going, or am I using it to make a actual trading decision, or am I using it to find an entry point? But moving averages also help us see support and resistance. So if investors take the time to master the moving average and the benefits it provides, they will access to a wide range of tools that would not be able to harness otherwise. With these implements, Forex traders can make better informed decisions and increase their chances of meeting their investment objectives. So in theory, there are infinite numbers of simple moving averages, or EMAs or DMAs. If you think you will produce some weird 46 SMA to beat the markets, as I told you, don't. Okay. Now, while I don't advocate you follow everyone else, it's important to know that what other traders are looking at is clues. So for the most popular for short-term or hyper traders is, and if you're trading in very short periods of time, a 5-period moving average. But then the most popular is a 10-period. And it's great for us short-term swing traders. 20 is really the last stop of the bus for our type of trading, for looking at primary trends. 50 would help us gauge environmental trends. At 200 is way left field, unless you're looking at investing as opposed to trading. So some traders will tell you to try a simple moving average trading system where you buy and sell if the price breaks above or below, as I told you, the red light, green light system. In the end, it comes down to what you feel comfortable with and what your style is. The EMA gives you more and earlier signals, but it also gives you false and premature signals. The SMA provides less and later signals, but also fewer wrong signals during volatile trading. When you're a short-term day trader, you need a moving average that is fast and reacts to price changes immediately. Now, here on this chart, you can see what I was talking to you about before with using 3 different moving averages. In this case, we're using a 21, a 50, and a 10. But if you can see the relationship between the fast and the slow moving average and how the 3 moving averages fan out and cross each other, and what happens when all 3 cross, or the longest moving average crosses a shorting moving average. Okay, it gives us a lot of information about how prices are moving and what is happening with the trends and where to get buy and sell signals. Another well-known adage is that a lot of traders who have 2 or more moving averages will call the difference between the fastest and the shorter moving average dead man zone. They won't make any trades at all when the prices between the 2